Hello and welcome back to the Market Lens after a short hiatus. As usual, I'm joined by AP's Chief Investment Officer Cliff Walsh. All of our previous Market Lens episodes are available in the Studio 454 video library or on YouTube. We hope all AP advisors enjoyed our virtual conference. I'm sure I speak for most of you when I say I'm very eager to get back to meeting in person for our next conference. Let's jump right into the news or noise segment, which will focus on global shipping. The Baltic Dry Index, the benchmark rate for global shipping, was down 3 weeks in a row, which marks a 3-month low. Prices have pulled back nearly 50% from the peak. Is this reopening friction beginning to thaw? Is this news or noise?
Absolutely, it's news. I've been saying for a while now that inflation is transitory, a result of a supply-side shock where reopening demand has outpaced the economy's ability to get back up to speed. It appears as if in many industries things are starting to thaw and restocking is occurring or has occurred. We're seeing a significant pullback in a host of commodities, many down 25, 30, even 40% in recent weeks. Pork bellies are down over 30%. Do you know what that means?
It must mean bacon deflation.
Bacon deflation.
Do you think this means the Fed will still taper its balance sheet? At this point, I feel as if the Fed will lose lots of credibility if they don't begin to taper sooner rather than later, and not to mention the futures market are calling for rate hikes starting in June.
Well, not because of the direction of bacon prices, but at our recent conference, I talked about the possibility of a policy mistake by the Fed. They no doubt should reduce the size of its balance sheet as it intends to do this month with the beginning of its taper, but I believe their aggressive plan may prove to be too much too soon. We are not dealing with an economy in late cycle that is overheating. We're actually seeing growth slow dramatically. Q3 GDP was only 2%, and I would be willing to bet it's going to be revised down. The bond market appears to be fading growth and inflation, while the equity markets are still partying on. Sentiment is at extremes in hatred for bonds and love for stocks. It may continue into year-end, the good old Santa Claus rally, but I can't see how this continues for much longer. The Fed is going to start its taper, but my guess is that it's either paused or gets extended in terms of its target completion date. You mentioned the possibility of rate hikes starting in June. This would be immediately after the taper is complete, according to the Fed's plan. I think there is a very strong possibility that gets pushed out. I don't see how you could go wrong, owning bonds at any spot on the curve at this point. The thaw is happening, and the hyperinflationists are going to be proven wrong.
Yes, you briefly mentioned commodities earlier. It's hard to mention commodity prices without talking about China.
That is true.
Yeah, so why don't we zoom into today's Market Lens, which focuses on what's been going on in China and the impact its property market is having on the broader emerging markets.
Absolutely. There's a lot going on there in China, and it's hard to isolate one event, no matter how large, and say it's responsible for everything we're seeing in the emerging markets. But the defaults at Evergrande and elsewhere, and the impact the Chinese property market has on the broader economy and emerging markets is significant. China's real estate market is 4 times larger than the country's GDP and accounts for about 30% of annual GDP.
Yeah, I know plenty of people that would argue it's the most important sector in the world.
It very well could be. The demand for commodities and the labor market impact has been huge from this sector. To put this in perspective, the U.S. housing industry is only about 5% of U.S. GDP. Right now, we're seeing double-digit pullbacks in home sales during what is typically the peak season in China. I think the combined sales of the top 100 developers dropped some 36% in September, year over year. This is going to weigh on economic growth in China and the surrounding economies in the fourth quarter and potentially beyond. Manufacturing activity recently went into contraction territory, so negative trends certainly developing and a lot of uncertainty.
Okay, so what are the immediate investment implications here?
From an equity market perspective, we've seen significant underperformance from a 1, 3, and 6 month time frame in the emerging markets, trailing the U.S. markets by high single digits. I believe China's weakness is the reason. The Shanghai Stock Index is flat this year, while the Chinese high yield market has seen yields blow out to north of 20%, which has basically shut down new issues there.
Yeah, and the property developers are major players in the junk market, right?
Yes, and there are billions and billions of repayments due and refinancings necessary in the next few months that could be very troublesome. We think it gets worse before it gets better, but we think there could be some pretty interesting opportunities develop if another shoe does drop. If you're willing to take more risk, the greater opportunities will be directly in China, but that comes with a lot more uncertainty and volatility. If you're more risk averse, the broader emerging equity and fixed income markets could still provide outsized returns, but will be more muted.
Thank you, Cliff. I appreciate your thoughts on the topic, and that wraps up this episode. We thank everyone who joined, and we hope this lets you see 2020. Take care.